If you're running a business in India, you know exactly what I'm talking about. You've closed the books, you see a nice net profit, and you think, great, now I know what tax I'll pay. But hold on, there's a twist. The profit in your accounting books is almost never the profit the tax department actually looks at. It's a classic puzzle, right? Well, in the next few minutes, we're going to crack it wide open. So let's just get right to the heart of it. That number your accountant shows you, is that your taxable profit? The simple, straightforward answer is nope, not even close. And understanding that difference, that gap, is absolutely the key to getting your business taxes right and staying out of trouble. Okay, so let's get visual for a second. Your book profit, the one on the left, it's pretty simple, right? You take your sales, you subtract all the expenses you paid, and boom, net profit. But when we look at calculating your taxable profit, things get a little different. The sales figure, yeah, that usually stays the same, but that expenses line, that's where the plot thickens. The income tax department has its own very specific rulebook on what you can and can't deduct. Our mission is to figure out how to get from one to the other. And the best way to do that is to think of it like a tax funnel. The very first step, right at the top of the funnel, is to take your net profit and start adding back certain expenses. Now, these are real costs, money that actually left your pocket, but for whatever reason, the income tax act says, sorry, you can't count that when calculating your tax. And here is one of the biggest traps, especially for small businesses. Cash. Under Section 40A3, if you pay more than 10,000 rupees to one person in one day, in cash, the whole expense is disallowed. And here's the kicker. It's not just the amount over 10 grand. Nope, the entire payment gets added back to your profit. It's a huge deal, and it's designed to push everyone towards digital payments. So, just to be super clear here, disallowed expenses are not imaginary. You really spent this money. It came out of your business. But in the eyes of the tax law, for the purpose of their calculation, it's like it never even happened. So your book profit went down, but your taxable profit, it stays up. So what kind of things are we talking about? Well, personal expenses are the obvious one. Can't claim your groceries as a business cost. You also can't deduct the income tax you're paying. The logic is, that's a tax on your profit, not an expense you paid to earn the profit. Be really careful with payments to relatives. If you pay them more than the market rate, that extra bit gets added back. And this last one is huge. If you're late paying things like GST or PF by the tax return deadline, you lose that deduction for the year. You've got to be on time. All right, so we've added back the stuff we shouldn't have deducted. Step 2 of our funnel is a bit weird. Now we have to add certain incomes that the law considers profit, even if they never showed up as revenue in your regular accounting books. They're called deemed incomes. So what are these kind of phantom incomes? Well, imagine you wrote off a bad debt last year and took it as an expense. If you suddenly recover that money this year, guess what? It's now taxable income. Or let's say a supplier just decides to waive a bill you owed them. That's a benefit to you, so the law sees it as income. Basically, if your business got some kind of value or benefit, the tax man wants to know about it. Okay, we've done the adding back and the adding on. Now for the good part. The final step in our funnel is we get to subtract deductions that are specifically allowed under the Income Tax Act. And the single biggest one, the one that's almost always different from your books, is depreciation. See, the tax law doesn't care about your one specific laptop or your individual office chair. Instead, it groups similar types of assets together into what's called a block. You just start with the value of that block at the beginning of the year, add any new assets you bought, subtract the money you got for any you sold, and then you just apply a set percentage rate to whatever's left. It's actually a pretty clean system once you get it. And of course, not everything depreciates at the same speed. The rates are all set by the law. So a building might be at 10%, your general machinery at 15%, but computers, they get a whopping 40%. The government recognizes that your tech gets outdated way faster than your building does. The type of asset is everything. And hey, if you're a manufacturer, listen up, because there's a really cool bonus for you. On top of that normal depreciation we just talked about, you can claim an extra 20% on brand new machinery in the very first year you start using it. It's a fantastic incentive to invest in new equipment. So let's bring it all home and look at our tax funnel one last time. It's a simple formula. Start with that net profit from your books. Then you add all those disallowed expenses. You add on any deemed incomes, and finally, you subtract the tax deductions you're allowed, like depreciation. And what drips out the bottom of that funnel? That is your actual taxable business profit. That's the number that matters. Now, if you're looking at all those steps and thinking, wow, that is a massive headache for my small operation,
And let's be honest, it definitely can be. There's some very good news. The tax law has built a shortcut, an escape hatch, called presumptive taxation.
And the magic of this is just how simple it is. The whole idea is you get to bypass all that complicated funnel stuff. No tracking every little disallowed expense, no complex depreciation charts. The law just says, hey, we'll presume your profit is a simple, fixed percentage of your total sales. That's it. It makes filing your taxes incredibly straightforward.
So here's a quick look at how it breaks down. For most small businesses, your profit is just assumed to be 8% of your cash sales, or even better, just 6% of your digital sales. For professionals like doctors or lawyers, it's a flat 50% of whatever you build. And for truckers with a small fleet, it's just a fixed amount per truck. Simple, right? It's designed to make life easier.
So at the end of the day, whether you go the detailed route or you take that presumptive shortcut, I want you to remember one thing: the tax adjustment funnel. It's the framework that connects your world to the tax world. You start with your profit, you add what the law says you must, and you subtract what the law says you can. It's that simple. And with that, we're wrapping up. But I want to leave you with a question, a challenge for your own business. Now that you know this framework, what's the single biggest adjustment you need to keep an eye on? Is it those cash payments? Is it depreciation? Really think about it. Answering that question is your first real step to mastering your business taxes. Thanks for tuning in.